Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are again, back at 360 HQ, back for another podcast.
Back in the recording studio, Andrew, absolutely. So,
well, now there's a video. People can see that this is just our meeting room rather than a recording studio. But for all our listeners, you didn't hear that.
Andrew, what are we talking to everybody about today?
Yeah, so back again with another monthly market wrap. So really talking about what's happened in financial markets, what's been happening over the last month or so. Just been pretty jam-packed.
It's actually great from our perspective because it means that we can talk about a lot.
Yep.
In kind of a good way or a bad way. I mean, we'll get through it and see what's what. But yeah, there's definitely been a lot happening. So there's a lot of meat on the bone for us to get through today. And it seems like everywhere you look, there's just another thing to talk about and another thing to consider.
I don't know if it's just all the time, whether that's always happening with financial markets and there's always something to talk about, or whether it's just since we've introduced this segment into the podcast and now that we're talking about it, it's just blown up in terms of news. But no, I think there's just always something to talk about.
So market wrap, let's start with the big one that's doing the rounds, which is really kind of the thing that's kicked all of this off. But Silicon Valley Bank, SVB. Second largest collapse in American banking history, $300 odd billion. Let's talk about what happened.
Yeah, 16th largest bank in America.
16th largest bank, wow.
Yeah, so we're talking about, we're not talking about a small scale, mum and dad lending institution. You're talking about a relatively large bank. But yeah, if you haven't heard about it, you must have been living under a rock. But SVB Bank has collapsed. So there's definitely a fair bit of news there, and definitely something that really shows when you push interest rates up as hard as what the Fed and what everyone has been doing around the world, eventually something is going to break, and the weakest link in the chain has been found out, I guess.
I mean, look, we might just spend a couple of minutes just talking about, because I think this is critically important, but how in today's day and age can a bank collapse? So Silicon Valley Bank, we might just do a really quick segment on this, but Silicon Valley Bank was, I guess, the bank in California in America, was known as the bank that Silicon Valley went to. And really, I guess what happened in the simplest terms is people deposited money with the bank, and you expect a rate of return similar to what we get in Australia. You go and put money in your bank in an online savings account or a term deposit. So the bank, guarantee you a 4% rate of return.
Yep.
And then you as a mortgage holder go and borrow that money from the bank and buy a house and pay 6%. So they give me 4 as the person who's given the bank the money. They charge you 6 as the person who's borrowed the money, and the bank make 2% in this hypothetical scenario.
Yep.
Now Silicon Valley Bank, what they've done is the money that they've received from me, being the depositor, they've gone and bought bonds with it, which ordinarily is the way that they do it.
Yep.
If they can't lend the money out. And that's okay, and they need to put that money somewhere. But the problem that they did is they bought long duration bonds. So the bonds that they were buying, and when they bought them, were at a really cheap, the interest rate was really cheap. The official cash rate was really cheap. And what happened is that those bonds were longer term in duration, and then interest rates started going up. And if you've bought longer term duration bonds at a cheaper interest rate and interest rates keep rising, the bonds get less and less and less valuable. What happened in this case was that the depositors, such as myself in this example, went to get that money back out from the bank, and they had to break those 10-year bonds or those longer term duration bonds and then sell them at a loss. Everybody started getting wind of it. Everybody did a run on the bank and started withdrawing their money, and all of a sudden they didn't have enough money in order to meet the people who wanted to withdraw their funds.
Yeah. And I think the other really key aspect, and probably, for all our Australian listeners, it's something that's quite foreign, but most lending or most home loans over in the US, they're fixed for life. So you take out a home loan at 2% interest rate. That's the interest rate that you're paying for life until you sell that property or until that's moved on. And so they're paying more out in terms of the interest rate that they're paying on all of their depositors, but they're not receiving any additional income in terms of all of the mortgage holders that they had. Now, one of the other issues was that in America, this loss that they had made on the bonds, they didn't necessarily need to disclose it to market. So it was a footnote in their financial reporting. There were some other things that had also happened, which is still kind of yet to come out, and there's some investigation that's happening. But they were without a compliance officer for a significant amount of time. It looks like there was some pretty serious mismanagement at the very least there, and so I guess one of the big things to kind of note, or one of the things is an important takeaway is. This is something that, looks at the moment like it's fairly isolated in the sense that it was mismanagement rather than something that's likely to impact the entire banking sector. But absolutely still some more information to come out on that one.
Yeah, and look, out of the back of that, and we'll keep moving on, but we did see Credit Suisse collapse as well, and UBS had to step in with the Swiss government to buy them. And to help prop them up, and basically that was an issue not unrelated to Silicon Valley Bank, because the Credit Suisse issue was out there for quite some time, but the issue that I guess the financial markets were concerned about was that banks lend to banks as well too, so there's all of these relationships and money flowing backwards and forwards, and it's difficult to be able to tell the extent of that because it changes on a daily basis. So I guess the risk was, and we haven't seen too much of it, but the risk was that, hey, there's some contagion here and this could potentially spread and become a banking crisis. It's really positive to see the Swiss government in particular, and even the US government as well too, stepping in very, very, very quickly to be able to shore up their banking positions, and basically they've committed to doing whatever's necessary in order to support that, because we don't want to go through another GFC style banking crisis.
Yeah, exactly right. So after that, and literally straight after that, the Fed raised rates.
Which is quite interesting, isn't it?
Yeah, I mean, look, that was fairly in line with expectation.
Yeah.
So the market was expecting anywhere from kind of 0 to a 0.5% or basis point increase, and the Fed raised rates by 25 basis points. So it was in line with expectation, but there were some people that were thinking, hey, maybe everything that's happening might actually put a stop to any interest rate hikes. But that didn't happen, and the Fed raised rates by 25 basis points thereafter.
Which is interesting because they continue to raise rates, but they threw a lot of money, like Silicon Valley Bank, similar to Australia, where deposits are guaranteed up to $250,000.
Yep.
That's the same case in America. However, the government came out and said, we're guaranteeing everything.
Yep.
So it's interesting that they're throwing that support, and yet at the same time, they're increasing interest rates, because their behaviour doing that is inflationary in nature.
Yeah, I guess what they're trying to do is really, make sure that they're still trying to clamp down on inflation, which is much more difficult in America because your mortgage holders are not being impacted by increasing rates, but they also want to maintain security in the financial sector, and they really don't want, something like a GFC event and Lehman Brothers that we remember all too it's something that's definitely sort of ingrained in the memory.
I guess the tech sector as well too is a large part of the American economy,
and is already feeling some pain at the moment as well.
Yep, with layoffs and a bit of a downturn and things. So wanting to protect that obviously makes sense. So I get why the government have done it. But look, the positive out of it is that they've responded, and they responded really, really quickly. So, not that there's not going to be issues moving forward, but it's good to see that the people who need to be looking at it and managing it are prepared to respond quickly when and if it does happen.
Yeah, no, absolutely.
Andrew, a bit closer to home, Standard & Poor's, the market for the month of March.
Yeah, I mean, look, S&P was up I mean, marginally, we're talking about, 0.16%. So really not all that much for the month. We're not talking about any sort of major rises or anything like that. But the other thing was actually quite interesting was, just bringing it back to interest rates for a second, is when Powell was quizzed, they were talking about the fact that, the market was factoring in potential rate cuts over the course of later on this year. And Powell was actually quizzed on that. And it was interesting to hear his take that the Fed really had no expectation to drop rates this year. So market expectations kind of readjusted a little bit thereafter. But definitely quite interesting to see that the market is factoring in something that's very different to what the head of the Fed is talking about.
Yeah, and the other thing that's interesting as well too is that we're starting to see some employment data come out of the US, and it's pointing, and we're starting to hear about it, but it's starting to point to some larger scale redundancies. Earlier this morning, I was reading something about Facebook or Meta, and they were talking about another round of cuts. And that's a common story that we're hearing across a lot of the big, well-known companies in America.
Yeah, Amazon had done it recently as well. It's something that's starting to come through in terms of redundancies and the potential impact to unemployment.
Which is interesting because the inflation number, the unemployment rate, and what the Fed are doing in terms of the cash rate all kind of work together. There is a bit of a lag effect. So trying to get that balance right between seeing the data come through and then saying, okay, hang on a sec, do we go, do we not?
Yeah.
It's going to be interesting to see where this ends up.
Yeah, all this talk of soft landing and it's yet to be seen how it's all going to play out. But yeah, that's definitely kind of on everyone's agenda at the moment.
There's this talk, they call it the narrow runway.
Yep.
And I don't know how big this plane is that they're imagining, but I see the runway getting narrower and narrower and shorter.
Yeah.
But look, we'll wait and see and see what happens.
Yeah. No, absolutely.
Reserve Bank.
Yes, Reserve Bank. I mean, look, we're recording this podcast at the end of March. So by the time the podcast actually comes out, we definitely would have already had an RBA rate decision.
So the RBA rate decision will be yesterday.
Yes. By the time this podcast comes out, it will be yesterday.
Yep.
Bit of inception there.
Yep.
But look, expectation is the RBA is going to hold rates. The expectation in the market's factoring in that it's extremely likely that there isn't going to be any interest rate movements for this month, which is kind of off the back of a couple of things. One, obviously, the banking sector and what's been happening over in the US. And the other thing was the inflation data that's also come out very recently as well.
So inflation data was lower than expected. It came in at an annualized rate of 6.8%, which is lower than what I guess the markets were expecting, which is a step in the right direction. It's going to be an interesting one to see if they do pause, because that's what the market is factoring in. And you're talking to chief economists and things, and they're thinking that the market will pause. The Reserve Bank will pause. The interesting thing is, and I guess this is the challenge for the RBA, and the RBA governor's already got his back up against the wall because everybody's calling for his resignation. But whether or not they do pause and they take their foot off the interest rate lever and they do it prematurely, and this is just a bit of a blip in the numbers.
Yep.
And then all of a sudden we see that, we had an opportunity to continue to push inflationary pressure down, that if we pause and kind of don't increase rates, then what happens? So it's going to be very interesting to see, one, what the result is, but two, I think even more critically, is the notes that come out and whatever they've used to justify their decision. It's going to be really interesting in terms of the insight as to what happens. So I think we are going to see a rate, and look, because we are talking about it from yesterday, it's a bit of It's
well, all the listeners will know whether you're right or wrong in your prediction.
That's right. So I'm trying to describe an answer here where I can hedge my bets. But no, look, I think there's justification for pausing. But I think if we get it wrong, I think it could be worse and inflation could be entrenched. And I think, we've come this far, another 25 points won't be extremely detrimental just because of the previous impact that all of the rates have had to homeowners. But I think it could be detrimental if we get it wrong for the economy.
Yeah, well, the risk is that if you don't go hard enough now and inflation starts to get out of control again, well, then all of a sudden you're not looking at, another 25 basis point increase. You're looking at having to push it a lot further and a lot harder in order to bring that back down under control.
Yeah, and the other thing too, I mean, it's not just the inflation rate. I mean, that's one indicator of it. But if you take something else into consideration, like the rental market,
yeah,
the things that are happening in the rental market are just crazy.
Yeah.
And that's an inflationary lever as well too. So all of a sudden, an apartment in a particular suburb is going for X amount of price, and then landlords are increasing the rental amount by a huge amount. That has an impact as well too. So it's really difficult because certain indicators that the Reserve Bank and the economists use in order to make a prediction or their decision, they're talking two different things.
Yeah.
So it could just be a timing issue, which I suspect that's the case. But how big is that time between when it happens and actually when you start to see the data start to soften and head in the right direction?
Yeah, well, look, the rental market's been something that's, really been doing the rounds in terms of financial news because the impact of it has been massive. And you can kind of see both sides. I mean, one, there's obviously a demand there, which is what's fueling that. And when people are not necessarily looking to purchase and they're looking to rent, well, then that's only going to push demand up. And in addition to that, you've also got, homeowners and landlords that have these investment properties, and all of a sudden they're looking at their mortgage expense going up. And so if they can push up the rental price to any degree, they're really going to try and, cut the hole that's in their deficit as a result of it. But yeah, it's all things that will then, impact inflation and impact what happens from a future interest rate decision as well. So we'll definitely need to kind of wait and see what happens with that. While we're sort of on the property topic, it was actually really interesting that I think it was only yesterday, CoreLogic had come out with some data around increases in property prices. They're looking at, property prices that have increased sort of over the last, really, we're talking about a week. So we're not talking about anything substantial.
Some fresh data though.
Look, it's fresh data, and a lot of people are kind of seeing this positively, and they're saying that, hey, things are looking a little bit rosier, and maybe it's, time for the property market to,
it's a recovery.
To start its trend, but I think it's way too early to start talking about that. I mean, whether this is something that's, whether this is the tide is turning, or whether this is just a very, blip in the radar. I mean, we're talking about very small increases and only for a period of a week. But yeah, there is some good news on the property front, but very limited in that.
And that's really around the expectation that interest rates are starting to peak. And then there's also talk, because there are, like we said, there are some leading indicators that things are starting to turn, like the inflationary data. And there's even a little bit of commentary about when interest rates, which is really interesting, but when interest rates are going to start reducing as well too. So it could be the fact that people, homeowners, investors in the property market are seeing this as a positive sign, saying, hey, we're at that turning point, and a little bit more confidence has come back into the market where people are, feel a lot more comfortable getting back in and doing their, doing their purchase and doing the transactions.
Yeah, and this is going to be an interesting time. I mean, at times like this is when you start to see supply perhaps start to come into the market as well, because that's really something that's been lacking when you're looking at the property sector. So when supply starts to come back into the market, it's going to be very interesting to see, all right, how many buyers are actually out there,
yep.
And is demand going to meet up with that supply, or are we now going to get, found out that there's confidence in people that are wanting to sell their properties that, hey, the demand isn't actually there. So very, very interesting as to, what's going to be happening in that sector as well.
Like at the start of the podcast, Andrew, we were saying interesting times ahead, and I think that's going to continue for a little bit. I guess to sort of put a bow on it and wrap it up a little bit, we are going to continue to see a few different things that are causing volatility. So we kind of expect to be jumping around. There's different data that's pointing in sort of opposite directions, and then the Fed and the central banks are trying to navigate this and figure out where they take it. But I think the theme for the next little bit anyway is the uncertainty will continue, and we're going to see volatility across not only in investment markets, but just in terms of the economy and the economic things that drive the economy as well too.
Yeah, and I think at the moment what it all seems to be looking like is everyone is trying to call, are we at that turning point or are we not at that turning point? And so some of the data is pointing in a positive direction because, there's a possibility that maybe we're at, the peak of inflation. It's starting to come down. Rates are perhaps gonna, not going to be increasing like they have been, potentially cuts. Or is this kind of a blip in the radar and, we're nowhere near that and it's going to have to keep going, or we're going to have that pain for longer? I mean, it's very... it really is just kind of sitting on a knife's edge at the moment.
Kind of reminds me a little bit about the like Melbourne weather, right? So if you're a Melburnian, you're used to the weather changing its mind every 2 seconds, and 1 minute you look outside, yep, it looks good, I think that's happening, and the next minute it's pouring down with rain. So if you're a Melburnian,
you're used to this.
I think you're used to it, right? This is just a walk in the park. But for everybody else who's used to things being a bit more consistent, maybe that's a bigger consideration and a bigger issue for you. So,
absolutely. Bills, thanks again for another great podcast, another wrap on the market and what's been happening. To our listeners and our viewers, appreciate you tuning in, and make sure that you like and subscribe if you got a bit of value out of this one.
We'll catch you on the next one.
Thanks.
Thanks for listening today. If you have any questions on what we've talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.